Right. So Shiv Sehgal of Edelweiss is here with us to talk about markets today. BankX is also gaining by 1%. Shiv, let's try and understand the kind of signals you are reading as far as global markets are concerned. Last week we saw 3 down days for tech-based indices and Nasdaq as well, and it gave shivers to US markets, and we also kind of got a bit shaken, but things are stabilizing now. What are you making of the signals overall from global shows?
Hi, Jay. Firstly, thanks for having me on the show. So, bottom line is it's a clear trend right now that the Fed and US markets are currently the global leading indicators of what is transpiring in the world over. Whether you look at the overnight reaction and what has happened in Wall Street in New York is leading, and market participants the world over are extrapolating that with a higher correlation not only to developed markets but the emerging markets as well. And in that space, the Wall Street in Mumbai is no exception. But if you put aside the dichotomy that exists between Wall Street and Main Street in most leading economies and emerging markets for a minute, I think it's very clear to understand the leading indicator and the leading policy response, the levels of monetary intervention. No one could have imagined at the start of this year, with interest rates almost near zero in most of the developed world, and now even further promises to keep going with such aggressive intervention for years to come. Bottom line is money supply growth. If you look at the Fed website alone, it's tracking at almost 29% year on year. And in terms of indication to people, that's at a 60-year high. Nowhere since the post-World War II era have we seen money supply grow at such an exceptional levels. And more importantly, the signals from the Fed are very clear. If you saw Jeremy Powell's speech, which was a couple of days back, the chair of the Federal Reserve announced that the Fed had unanimously adjusted its sights higher to a more flexible form of average inflation targeting. Basically, what the Fed committee is now seeking is to achieve inflation that averages 2% over time. Now, if you look at inflation numbers in the US, and all our viewers know that, 2% is far stretched. It's currently averaging around 60 bips, right? Meaning the Fed will continue with its QE money printing programs for years to come. Currently, at the monthly rate of $120 billion, that's nearly 1.5 trillion per year. And as I said, if that is leading to this money supply growth, not only in the US, but in developed economies the world over. And what we have seen is that this Fed's easy money is pouring into a relatively smaller number of tech stocks, pushing these stocks higher and higher. Most of the media and Twitter is full of FANG stocks, but let me give a further analogy to our viewers. I would rather view the FANGman stocks, which also includes, apart from the FANG stocks, Microsoft, Amazon, and Nvidia. And maybe, for the retail euphoria, you can add Tesla and Zoom in the last couple of weeks. But interesting stats, the market cap of these 7 stocks alone is $8.3 trillion. That's more than the combined valuation of the 37 largest tech stocks that we saw in the 2000 boom. In 2000, the largest 37 stocks got to an average of about 7.95 trillion. And when you look at individual stocks like Apple last week before the jitters that you mentioned, was almost at 2.3 trillion. That was more than the combined valuation of the entire Russell 2000, which is the small cap index in the US, and more or less equal to the Indian market cap today. So let's be clear, the elephant in the room is the Nasdaq. I would urge everyone who's watching the markets, if you're not already read Charles Kindleberger's Manias, Panics and Crashes, in it he identifies the framework for analyzing the anatomy of a bubble. So the question remains still out there, are we in a bubble? In terms of valuations, during the tech peak in 2000, Microsoft got to 75 PE. Where it is today, it's around 45. So can we continue to move up? Absolutely. But the more important thing is, as you mentioned, right, this concentration that has happened not only in Nasdaq with 7 stocks, but even in Nifty, right, the 50% rally from the March lows till now, and not only Nifty, but every leading indicator index, right, you can attribute it to just 5, 6, or 8, 9 stocks globally. And I mean, we can blame today's crazy valuations or this concentration to very aggressive policy stance of what is transpiring in active versus passive money. If you were to just look at what has transpired in passive money over the last 4 or 5 years, Let me give you some more stats. Passive strategies now control almost 60% of US equity assets, while quant funds control almost another 20%, and that's a staggering 80% of total combined that is being controlled by passive strategies. If someone to ask me in terms of absolute numbers, if you look back 5 years, passive titans like BlackRock and Vanguard, which control bulk of these passive ETFs, their AUMs were around 8 trillion just 5 years ago. 5 years ago. Today, they're almost at 13.8 to 14 trillion dollars. And for the first time in the history of capitalism, as of August 2019, we had passive money strategies overtaking active money. And what is resulting is this: if you add the endowment funds, the pension plans, the sovereign wealth funds, that number in US comes to almost $20 trillion that is being managed by passive strategies. That is actually equivalent to the annual GDP of US alone. So you're absolutely right. This concentration itself is providing us, in my view, a false sense of belief that retail investors cannot lose money on great tech stock names because even passive funds are loaded with them. But the longer this lasts, the more unbalanced the market becomes because, inherently stability, long-term stability creates instability in itself. So, as bubbles pop, investors will learn a hard lesson. But just as buying begets more buying, as is the current form, as when it reverses, selling begets more selling, which was as exactly prevalent in, from end Feb to March. But, does the pop happen today? I don't think so, and the reason I say that is we are still...
let me interrupt you over here, Shiv. I want to understand from you, in this kind of an environment which you're talking about, do you see flows, these extra flows which you're talking about, the liquidity which is sloshing around globally, to make way into emerging markets like India on a sustainable basis, causing our own asset prices to rise further from here?
Absolutely. And the reason I say that is, see, the world today, bulk of the money today is chasing yields. And not only in Europe and Japan are yields negative. We have about $17 trillion in negative yielding assets. The reality is that with Fed coming out and saying what they've said, and most of the developed markets, near depressed levels of 0%, yields in emerging markets still look very, very attractive. So what happens is as the Fed policy, the first bulk of the money that is coming back to markets will always go into regimes that are actually printing money. And Fed being the reserve currency of the world, that has probably seen the first leg of this mania that we call the Nasdaq bubble. But you cannot, I would like to believe that math works. Let me give you an analogy. Like if Apple continues at the same rate of speed for the next 5 years that is done over the last 18 months, its market cap will be larger than the entire stock market is today. That's just the impact of compounding. Now, you and I both know that's not possible. It could be a fantastic company. It doesn't inherently mean it's a great investment in the stock right now. To me, it means that it may more be of a great trading vehicle right now for a lot of these strategies because it's liquid and it's moving and sloshing around. But the reality is that the first bulk of the money has gone into developed markets. As the US dollar, and we are seeing the bulk of the DXY kind of starting to see a downtrend. In my view, the US dollar peaks out in the next 6 months, and that provides a kicker to emerging markets like India. Now, even in emerging markets, India is probably at a better threshold than it was in prehistoric 10 or 15 years back, because at that point of time, we had BRICS. Brazil was a market darling, China was a market darling, Russia was completely correlated to oil, which 10 years back was, just before GFC, if you recall, oil was already at almost 140, 150 at the peak. So we have large 3 emerging markets, which are completely opposite of last 10, 15 years. And what leaves India today is that, we've been talking a lot about in social media as well, and you've talked to a lot of your commentators that have come on, that how can we benefit from this anti-China slogan that is probably the world over, right, because of COVID. I look at history a lot, and I have to go back to World War II when Germany was probably the most hated country globally, and we are probably in a similar phase today. That India can benefit and it will benefit. I think the government understands it. The policies and reforms, a lot of things have been announced. Now the onus is on both the government and private sector to take the lead and kind of win back this manufacturing and service industries that has the COVID opportunity has provided.
Right. Let's shift focus and talk about domestic market. The way things are happening in the last 2 days, are your team members giving you feedback that the funds are inquiring more about mid-cap ideas? Do you see broadening of the rally because of SEBI circular which came in, or even otherwise too, because this narrowness cannot continue and there is recovery, however slow or gradual it might be in the economy which is taking place? Is the money finding newer ideas in the market? Are you getting the same kind of feedback from your clients or even your team guys?
So that's the most valid question at the moment, right? I mean, I think if you recall, since January of 2018 is when the mid and small cap index in India peaked, right? We have already gone through 3 years of pain I would like to call it an asset allocation within equities. And the reality is that, when you have gone through downturns, which have lasted almost 3 years, we are almost at Jan 2021. In my view, the SEBI circular has only catalyzed and accelerated an underlying theme where people were looking at large caps and saying that these valuations probably are not sustainable. They can be sustainable in the event that liquidity only follows more and more momentum. And the momentum has been with the large caps for a while. But the reality is that I would say that per se, I don't expect the entire spectrum to see the kind of euphoria that lasted during 2016 and 17. But what it means is that more and more fund managers are asking us about strong balance sheet, right kind of growth areas, and stocks, small cap stocks and mid cap stocks that could be the next leaders in the next upcycle that is about to take turn the world over. I don't think that inherently we can have the large cap names continuing on the path that they have in the analogies that I just gave, the rate of compounding that they've seen over the last couple of months. At some stage you will see sector rotation, you will see asset allocation move away, that as we have been seeing from bonds into equities. Growth has been the number one phenomena and momentum has been the second. Within that, techs have been leading. And I think within the domestic cycle, let's be very categorical that the global money supply trade, right, has kind of, in the form that it has appeared, it is here to stay for a while, and no sovereign central bank is under any illusion or pressure to pull it back soon. And RBI is in a similar format. It's been a really boon for India that, as I mentioned, in BRICS, while if you look at currencies in what happened to Russia real in March and April, the Russian ruble and Brazilian real in through this entire COVID period, our currency has held up really well. And that's provided a further kicker to the government. And let's not forget, the biggest import for us, which is oil, is still hovering around. We probably saw an uptrend in the last couple of months, but again, it's back down below 40. That provides a big kicker to India in terms of getting its balances right. And, also one more point that I would like to add, that the bulk of the optimism that has happened has been mainly monetary led, right? And I would say that the fiscal is very much needed. That gives us the intermediation channel. I think the financial institutions are still overwhelmed and in themselves will not support an economic revival. And external support, a kicker and a booster is needed to jumpstart this real activity, as we come out of this post-COVID world. And to me, one more analogy in terms of the domestic markets, I think the Indian domestic cyclical rally needs to be watched closely, right? I think there are a lot of skeptics out there. My view is that between now and Diwali, there is enough business euphoria and enough optimism built. So I don't see, even if Nasdaq blips, as we saw in the last couple of days, to my mind, I think we continue an uptrend between now and Diwali. The real test for markets will come around the 14th of November when Diwali kicks in, which will be the real test of demand for corporate India, right? Businesses actually seem very, very optimistic around it, and so am I. But I think what I'm trying to say is that will coincide with the biggest event of the second half of this year, which is the US elections, right? For me, that will, the way that plays out will form the narrative around the short-term blip in the market that you're talking about. Now, I'm not here to talk about whether Trump continues to be in power or Biden wins, but to me, the biggest kind of blip or the risk factor that I see, which not many people are talking about, and I've not seen any market commentator come out and talk about, especially in a few smart guys in the US talking about, is the fact that for the first time in the US, we have a postal ballot in terms of elections. Should Trump lose and he challenge the fact that he does not agree to the outcome, I think that can postpone the certainty of the elections. And I think that could probably be another 1 or 2 months where this uncertainty remains. And let's not forget, any market, like whether good or bad, markets hate uncertainty. So my point is, irrespective of who wins, I think the more risk event to watch out for is, should there not be a clear mandate winner, I think that will prolong the process and markets will not take that lightly, especially from the elevated levels that we are already at.
Right, Shiv. Clearly that is something very important to watch out for as far as Indian markets are concerned and global markets are concerned, US elections all the time. Thank you very much for joining us on the show today, Shiv. And that was Shiv Sehgal from Edelweiss. Meanwhile, let's shift focus and talk about an exclusive story which my colleague Priyanka